Are good companies automatically good investments? It depends on how much you pay for the value you're getting. Let me use an example with cars. Everyone knows that Ferraris are very good and luxurious. You would have high expectations for it to perform as a supercar and expect the best from it. A Ferrari like the one in the picture costs $300,000. But what if someone came up to you and wanted to sell it for $500,000? You would think they're pretty stupid for overpricing the car. Even though it's the same awesome car, you don't want to overpay. I mean, it's still a good car, but just not worth it for the price that's way above what it's really worth. What ends up happening is that stupid seller would have to drop the price to a more appropriate level, which is close to $300,000. It won't be a crazy high price like $500,000, but it'll still be a pretty high price at $300,000. This is what happens often in the stock market to really fantastic companies like Amazon. Now, everyone loves Amazon as a global company, and as investors, they like to buy into its really fast growth story. But at one point, there's just way too much demand for the stock that it reaches a price where it needs to take a break because it's just gone up way too high, way too fast, to a level that doesn't justify its current worth. The price takes a pause and often gets reduced to a more appropriate level. Now, at the end of the day, it's still a very high price because the company is good. Once the company can prove that it can keep growing, the stock will continue to move higher. The opposite can happen where you can buy a fantastic car for a price way under its normal price. A Ferrari at $100,000 is a pretty much no-brainer choice to buy because you know that it's really worth $300,000. Although these type of deals rarely occur, they still happen. The fact that these deals are still a very high price, even after the discount, still scares most people from buying. Using Amazon as an example for this, a company as great as them also get their rare discount once in a while. Back in December 2018, the company's price dropped from $2,000 to roughly $1,300 on some news hysteria making it sound like the world was going into a recession. The deal was only available for a month before the price started to recover back to more normal levels. Again, most people would miss out a deal like this because of the high price tag even after the discount. But very unique to the stock market, what scares people most from buying into these deals is they think that the price will keep dropping. Unlike buying clothes and groceries on discount, people like to buy stocks when the price keeps going higher. So, how can you determine what's an appropriate price for the company? Usually, I would recommend people to look into the company's financials, but most people don't know how to do that. So, I tend to recommend taking the opinion of Wall Street analysts, guys who keep up to date with the company's growth story and they like to crunch the numbers to determine a correct value. On Yahoo Finance, you can check out Wall Street's target price for the next 12 months. It's a number that keeps updating as the company continues to develop and grow. Personally speaking, I would tend to reduce that target price by 10% because it may be inflated to get investors really excited. Now, once you have a target price that you would like to work with, you want to see what the upside is from the current price and decide whether or not that is enough upside for your comfort level as an investment. When the fantastic deal stops by, like that $1,300, you have to decide quickly whether or not that return on investment potential makes sense for you. And before ending this video, I'd like to ask you this. Do you think Amazon would succeed during a recession? So if you like what I had to say today, like this video and subscribe to my channel, and I'll be posting more of this content in the future.